now. He's the professor at Columbia University. And earlier, when I first met him, he was at Johns Hopkins. And I've gone and spoken at his class, I think 2 or 3 times. And I've always enjoyed the students who were in his class. They were very familiar with the concepts of housing. And therefore, I knew the training that he's giving them on the housing markets are very, very important. So he's very learned. He's absolutely on the ground. And the information, whenever I learned from him, was so important for me. Also, I was getting it from the horse mouth, which we would not get elsewhere in writing. So it was really learning from somebody who has his hands soiled at the grassroots. So, Professor Kose, with this brief introduction, I would like to invite you to please deliver a talk to us, and then we'll follow it up with question answers after your presentation. Professor.
Thank you very much, Sharon, for that extremely kind introduction. I feel like I learned far more from you than the other way around. And as you know, you've been very generous speaking to my classes as well. So this has been a wonderful joint working relationship on this side. Just a few words about my background. So I was trained as a pretty traditional economist. I have my doctorate from the University of Pennsylvania. But after that time, I decided I wanted to get practical experience in financial markets. So I went to Wall Street, which is where I was for almost 20 years until the global financial crisis. And that was a huge shock to everyone, including me. And to my surprise, I found myself right in the middle of that going to Washington. And I was in charge of capital markets analysis at Fannie Mae, the huge government mortgage agency. So I suddenly became a housing expert at the moment I arrived there. This was after the start of the crisis. So it was a very interesting time. The world was completely shaken up, and Fannie Mae was the center of it. After about, 6 or 7 years, it was stable. They were making money. It got boring. So I went to the IMF, and it was through the IMF where I met Sharon, and I was teaching at that time at Johns Hopkins as well. I returned to New York in 2018, partly because I was doing interesting research at the fund, but was looking for, there was not a well-organized set of support there for housing market analysis. And so I departed and I joined a fintech company, so that you'll see at the bottom Recursion Co. when I launch my screen. This is a small, we're a dozen or so people, and we have access to huge data sets in the mortgage space. And with these, we provide fundamental analysis tied to this as a consultancy, and we work with government agencies, investors, financial institutions. So I have these wonderful tools as well as at my disposal. And I teach at the School of International and Public Affairs at Columbia, where I teach global housing policy and also affordable housing policy, which is a big deal here as well. So I'm going to share my slides. Oops. Can I find it takes a moment to load. Okay, we will start from here. So, as I mentioned up front, so when I was the IMF, we had something going called the Global Housing Watch, which was set up as a monitoring and research vehicle when I was there about housing specifically. And so at that time, I became very steeped in activity in global markets. The last couple of years, it's been less so. So this has been an opportunity for me to to sort of look a bit at this. Okay. So, and also to take a look at the impact of the COVID crisis globally. I've spent the vast bulk of my time this year working on the implications of the pandemic in the US in housing and financial markets, and I haven't put my head up too much into the global space. So this is just a little bit. Fortunately, the IMF still has some very interesting publications, including their economic outlook, which just came out earlier this month. And so I just pulled a couple of charts from there to give a perspective. One of the things about COVID is it is both a supply and demand shock, right? In fact, the supply shock is what dominates. You remove labor from the market either through illness or through fear of illness, and so people don't go out. So the supply of labor in particular is sharply cut back, and that in turn has feedback through on the demand side. We saw that here. We had this spectacular decline. We saw some decline in GDP in the US in the first quarter, spectacular decline of well over 30% in the second quarter, which was not quite reversed in the number that came out here yesterday. I don't want to get too in the weeds here with the data, but we had a spectacular shock. But like a lot of supply shocks, the bounce back tends to be rather strong. It was the uncertainty and fear of how bad this is going to be. And certainly it was bad. There's no question. I'm located near New York, obviously, with Columbia. And we still have a long way to go to be back to normal. But the situation has improved considerably, and economic activity, while far from where it was before, has returned. So we had this very distinct V-shaped recovery, but the second half of the V is falling short of the first half. So kind of like a check mark, if you will, down and up, where we're below where we were, but nowhere near as bad as at the height of the pandemic. And you can see this was a distinctly global phenomenon. The other result was that we had tremendous policy thrown at us. I'll talk about the US specifically in just a minute, but we had fiscal and monetary policy country by country, a bit different, obviously, but still to the extent that it can, that it was there to be used, it was largely used. You can see on the left the 10-year bond yields. Again, in the US, which tends to have the highest bond yields, except maybe for Italy, which is always interesting, but that's a separate situation. And so massive efforts were taken to lower long-term bond yield. Policy rates were sent to zero or close to zero. In the emerging world, and again, in developing markets, some of the same tools were used, often in concert with the IMF, which at one point had 100 countries knocking at its door, trying to work out packages. I'm not sure how many it's actually working with at the moment, but quite a few. There are a different set of considerations, particularly with emerging markets and foreign currency debt, where there's concern about lower rates possibly leading to capital flight and financial distress. May offer something of a limit, but still things were actually put into motion. So the question then is, what does this mean for housing markets? So when I was at the IMF, I used to put together that looked like this chart on the left. So HPI is housing price index. that is on the y-axis. GDP is on the x-axis. This is cumulative growth between 2010 and 2019 in this regard. And so this was in the recovery from the Great Recession. You can see there was a distinct cluster of countries that fit very nicely along a line that had a slope that is just a bit greater than 1, because if you look here, it's 60 and here it's 80, but not much more than 1. It was a bit higher before the global financial crisis because we had widespread bubbles, but here it's pretty steady. And you can see the wonderful performer out here was India, which had both very, very good GDP growth and also expansion in housing prices. The US, interestingly, was right in the middle of this crowd. Then you always have outliers. So we can go on about outliers. Greece was a troubled country during much of the recovery period. And then you have a country, China, which grew very strongly, but was very worried about housing bubbles. So they put many policies in place to keep that from happening. You also had some other emerging markets, Indonesia, Turkey, which grew pretty well, but it saw very little in terms of house prices. I know less about what's going on there. On the right, we have the same chart just for the first half of 2020. And this is all OECD data. And I just found this very interesting. So every country that's in here, and there's 20 some, I can give you the list. It's pretty much OECD countries and large emerging markets. Experienced negative growth in the first half of the year, except for China, right? China had it earliest and they got it over with pretty quickly, right? But every other place. But what's interesting is that housing, as a rule, ended up doing pretty well. Again, it's very distinct from the global financial crisis. And someday I'll have to update all of these charts to look at this. The only extreme outlier on the downside was Hungary. What's going on there? But most housing markets were 2% or less fall, and the majority were actually on the positive side. Here, India had pretty much flat housing, but has suffered cyclically during this period. But again, what I find interesting is that the US is completely in the middle. We consider ourselves to be so special and different from the rest of the world, but here we are, clustered at the center, which I just thought was interesting given all of what we've been doing here. Okay, so let me talk a little bit about the US now and what we did here. So I was at a conference at Columbia, and one of my colleagues is Fred Mishkin, who's a very distinguished economics professor. He was on the board of the Federal Reserve during the global financial crisis. And what he was saying is that one of our reaction to the situation now and the fact that it occurred so quickly and worked so well had to do with policy tools that were built out around the global financial crisis. When the global financial crisis hit, the Fed still had a very conventional toolkit at its disposal, and it had to invent all kinds of new tools to throw at these problems. These were unwound to various degrees in the subsequent recovery, but nonetheless, these remained on the shelf somewhere at the Federal Reserve Board and were capable of being brought out. So at the end of March, we were experiencing the start of what appeared to be a very severe liquidity crisis in the US, and the Fed pulled out all the stops, not just in terms of setting rates to zero and buying long-term assets, but in terms of pushing liquidity into the technical corners of the short-term market. And the market recovered amazingly, and real assets recovered, right? The US stock market is not far from where it was before the crisis, and housing prices, if anything, have accelerated, and we will look at that. So that was a remarkable response. The fiscal response was similarly impactful. So we had something called the CARES Act, which had to do with a vast number of programs, including expanding unemployment benefits, individual checks to households, lending to small businesses direct by the government, much of which will be forgiven or are being forgiven. All in all, this amounted to about $2 trillion. We think now about the US political situation as being very, very difficult. But the thing to remember is during the global financial crisis, when President and Congress put together a fiscal package, they could only get about $500 billion through, and it was done with precisely zero support from the alternative party. This package passed with broad bilateral support. I mean, I think we can't work together. In this case, we did. And it was, again, very, very effective in terms of the immediate shock to the system. But it also included something here specific to housing, which is worth spending a minute chatting about, which was a real innovation known as forbearance. Okay. So I'm not sure how broadly this program has been broadcast, so I'll just take a second and describe it a little bit. But basically, anybody with a government-sponsored mortgage, which is almost everybody these days. There's the non-government sector, except for large private mortgages, pretty much went away after the global financial market. So we're dealing with the vast number of households. Our mortgage market is $10 trillion, and maybe 90-some% of it is government-sponsored one way or another. So anybody with that had the right to call their bank on the phone and say, I am distressed by the COVID pandemic. And from that point on, you were registered in a plan and allowed to defer your mortgage payments. This deferral goes for 6 months, but is renewable another 6 months. So it is, it is in place until the spring of 2021 for most people. But it's also, you can still enter a program now, even until the end of this year. So there will be some people who are not paying their mortgage perhaps until the end of next year. And you could see the total here, and the Fannie, Freddie, FHA, these are all the different government programs. I'm not going to get into all the details here on this, but that thick green line at the top is the total number. And you can see that got up to almost 5 million. And as the economy has improved and employment has come back, we're down to about 3 million now. And it's been pretty steady. As you likely know, our virus cases are picking up. Some places are starting to impose restrictions again. So what the future holds for this in the next few months, it's very difficult to say, but it's still a material number of households who are in these packages. Now, what happens here, if you do this and don't pay your mortgage, your credit rating is not impacted. Okay, so if you become delinquent on your debt, your credit rating, which is very crucial in terms of your ability to get credit in the future, is adversely impacted. If you default on your house, you can't get another mortgage for more than 5 years. It's a real big restriction. But in this case, it's cut off. It is also not forgiveness. It's not that you never have to pay this amount back. What happens is the amount you don't pay is put into a second lien of the mortgage and attached to the first one, and it becomes due at the end period of the mortgage. So that could be 10, 20, 25 years from now, but it doesn't go away. It simply puts it off on this side. Now, with a government-sponsored mortgage, what happens is investors are protected. So if you buy a Fannie, Freddie, FHA, VA, these government-sponsored mortgages as an investor, you are guaranteed against losses from credit risk, which is what we call it when people stop paying their mortgage. In general, it is these government agencies that backstop it. But if you are just delinquent. If you are just not paying, it's actually the banking system that is on the hook for this. It's only when the mortgage becomes in default, which usually happens about 4 months after you stop paying, that it gets switched to the agencies. This puts a huge burden on the financial sector. And so we've had to put in place many programs in order to help the financial institutions through this period. And again, it varies by government agency. It's a lot of detail. But so far, this has worked well. Housing prices, as you likely know and will see, have continued to go up. It's very different from the global financial crisis when housing prices plunged 35%. We've kept things moving. It's kept the financial system going for now. But one of the biggest outstanding questions for 2021 is what happens when this program expires in the spring, and what will happen to these borrowers. Because if they still can't pay, then you may have to go through this process of entering in default, which can cause some stress to the financial system. Or it may be that enough people have their jobs back and things are improved where that isn't too big an overhang. But this is a big issue for next year. There's obviously the program could be extended, but there isn't much appetite for letting people go too long without paying their mortgage and just deferring that. There's also an interest in getting the issue behind us. So that's a big policy issue in the U.S. So I'll look a little bit at the cycle here for U.S. housing. This is a company called Redfin, which is a online housing broker. So you can go to Redfin and buy a house just online. In the old days, you used to set up a tour of the house. These days, you can do it virtually, put an offer on the house, and we also have online mortgages. So we can go online and get a mortgage. Except for the moving, you can go through this process and not actually have to meet a human being. Even all the paperwork and stuff, we have all these signings. We've set up all these high-tech signing things, appraisals. There are appraisal waivers. There are technical appraisals using video cameras in houses, that the people on the inside can show the house. And so this process has generated a lot of innovation in technology. So the chart on the left is new listings. So these are houses for sale, right? So this is an excellent measure of supply. You can see, and I have 3 years of data here, so 2018, 19, and 20, the blue line being 20. Suddenly in March, things came to a screeching halt. The period between March and May was peak uncertainty. Nobody knew what was going on. People were afraid to put their houses online. Builders were not wanting to do things. It was just a shock. Starting around May, all of these programs started to kick in. People came out looking for houses, and you can see the numbers gone back very close to what a normal seasonal pattern was. On the right is sales. This is pending sales, so this is demand. A pending sale is when you sign a contract for the house, so it's a very timely indicator. You can see kind of a similar pattern, but not as deep. You can see that there were fewer sales right after the crisis. You can see that there is normally a distinct seasonal pattern in sales in the U.S. People buy their houses in the spring, they move in the summer, they send their kids to school in the fall. That is the classic American cycle of housing. You can see it's been completely distorted. The spring selling season was to a large extent wiped out, but we are experiencing a spring selling season in the fall, and there is just tremendous demand, far more than what you had seen even in the peak of the selling season. The demand exceeds supply. What do we think will happen? Well, of course, prices are up. And you can see this is median prices year to year. So 2019 greater than 2018. 2020 is massively higher. Again, there's a seasonal pattern. We've had virtually none of that. And this is a response both to the policy. We have record low interest rates, which I'll get to in a second. I thought I had it here. Okay. So we have record low interest rates. The 30-year mortgage is below 3%. It was about 5% as recently as 2018. And we also are experiencing a huge shift in preferences. People are leaving the crowded cities and buying houses in suburbs and more rural areas. These two factors together has generated an immense boom in housing. Housing was not the cause of this crisis the way the global financial crisis was, but it is distinctly a very important part of the solution of the process, is an active housing market. So in the details of pricing, we can see a new normal emerging. So this is also Redfin data. These are 3 lines in terms of year-over-year changes in house prices, rural, suburban, urban. You can see the numbers move very close together for 3 years, a little bit of noise surrounding them, not much. As soon as the crisis hit, though, you saw this massive switch, things fell, and as we recover, a distinct widening out. So you see the rural areas are doing better than the suburban areas, which are doing better than the urban areas. And that is definitely a shift to keep your eye on, and probably very important for the longer run, the next 5 years in this market. So the structural issues are, a move towards persistent social distancing and enhanced workplace safety. We are moving to less density. We are moving to less density in housing. We are moving to less density in offices even. And what we are looking at is enhanced resiliency. Again, this is something that isn't necessarily or even likely to turn around to a great degree going forward. Scarring, that's the behaviorist term. It's a sort of behavior about your belief in long-term trends. We've had, urbanization has been a key part of the of development for decades. But in the U.S. recently, we were even getting center urban cores doing better than outside the center. It's really been a flood into the center of the cities. That now is being very much challenged because a lot of people live very packed in a small space. And we also are seeing, again, persistent labor impacts because there are whole sectors of the economy, retail, for example, a lot of service sector that may be impacted for a long time. And these are people who are going to have to retrain themselves. So we have some reduced growth potential. And of course, as Sharon and I were talking before this, technology here is remarkable. We are proving to ourselves that we can function remotely pretty well. And I will mention a bit more about this shortly. So we had here from the really late 40s through the 1970s, a flight from cities to suburbs. There was a great emptying of the cities in the US, causing all kinds of economic problems in the cities. But with the turn of this century, and especially after the global financial crisis, there was a real move back to the urban core. There was gentrification. It improved. People liked living close to each other, all the social amenities. And so you can see I have here home values from 2000 to 2018 going much, much higher in the urban core than in the suburban areas. But what is happening right now from that Redfin chart here, we seem to be getting a reversal. We seem to be getting backwards movement here. What I have here is a view of the US in the 1950s, which for all the gender issues here shows all of the moms and their kids in the yard. But what's interesting is that those vans are diaper delivery services. So it showed even then that technology in terms of the telephone was a key part of making this possible. We didn't live close together. It was hard to shop. shopping came to you. So we're kind of going back to that at a much more high-tech area. A key difference going forward is going to be this work from home phenomenon. More and more, it's looking like there is going to be broader acceptance of this in the post-COVID period. It was even catching on to a degree, really, since the global financial crisis. More and more firms were realizing the hardships related to commuting, and we're making work from home options, at least part-time, more available. This is an interesting chart from the consultancy PwC, that even before the crisis, it was only about 40% of office workers who didn't have the option of working from home, and an equal number that did. So it just came during the crisis. Of course, hardly any office worker is in the offices there, and the rebound that we're looking at looks very modest. More and more, it's looking like you're going to have people with set schedules, perhaps not even set offices, and that will set off major issues with regards to consolidation of office space and impacts on the urban areas, which are just going to have less people coming to them every day than there were before. Some people have moved. Some people who are out there will simply be coming in less often. So this sets up real questions for urban planning and a variety of other issues. Again, a lot of people after a year here, they want to go back and see their coworkers, but they are not so anxious to get back to commuting every day in a jam situation to do it. They'd be much happier in a more open space, just coming in even a few days a month than doing that. And also, we're seeing construction of offices in the outlying areas. So on the left is an office complex in Connecticut outside of New York City. And we're seeing more of these local hubs. People have less commuting, less crowded. That's heading in there. There is a counter trend to that, though. There are people who believe strongly in that we will come back, and particularly tech workers. The building on the right is an old New York City post office right by Penn Station, if you know New York very well. That has just been taken out on a long-term lease by Facebook, which is fixing that up, and they will start putting about 10,000 employees in this space starting around 2022, 2023, something like that. So Amazon's doing something similar. So while I'm seeing traditional businesses, business services, banks moving out, there's still a view that young, technically trained people are, especially if they're just out of school, their memory of this will fade and they'll want to come back to this. It's going to be very interesting to see how it develops. I just have a couple of points about related issues. I do a lot of work in the U.S. these days on affordable housing. It's a very big program. If you're aware of how we do it here, I know Sharon is because we've talked about it. But we have tax credits and bank regulation that conspire to build the bulk of new affordable housing in the U.S. This has been largely an urban proposition, but if more jobs and more people stay in the suburbs, it may be that there are more jobs for lower income people out there than there were before. And we're going to have to rethink just the way we organize it. So on the bottom left, we can have small apartments in the exurbs and infrastructure like light rail or buses that take you where you need to go, as opposed to the top, the very centralized, large central city construction and the packed-in subway that we're used to. And again, how you invest your resources now, you need to think several years ahead. This is a very, very big challenge. One other aspect, and I'd be interested in knowing how global this is that more and more financial business is going to non-banks. And that has accelerated remarkably since the COVID crisis. Non-banks tend to be online. Banks tend to be branch-driven. the people got a certain comfort from going to their bank branch and working with the employee, filling out the paperwork, walking through the process, this sort of thing. Since COVID, much less. Lots of bank branches are closed, and if they're open, you're not going to be there very long. And so we have seen, and these are two different U.S. programs. The number is getting something like 70% of new mortgages are coming out of the non-bank sector. That creates all kinds of regulatory issues. We're regulating the banks, but the banks are less important. And the non-banks often get their financing from banks. So, this is creating all kinds of issues. And it's something we're going to have to deal with in coming years as a result of this. Another issue is municipal finances. If we are not coming in the city, we're not generating the tax revenue. I have some charts here. The bulk of tax revenue for cities comes from the local economy. It does not come from grants, like 80%. From states or the federal government. And if people aren't riding the subways or going out to lunch or shopping in the stores and instead doing it all online from the suburb, this is going to create a huge hole in municipal finances that's going to be very difficult to fill. And this is something that the new administration will have to deal with fairly early on as far as it goes. And I just end with my favorite charts here, which is that the global financial crisis actually was a test run of many things: technology, policy making. We learned what worked okay. We learned what worked less well. We applied those answers to this environment. And now we have this horrible crisis that's facing us. And I'm thinking of it more and more as a test run for the next great crisis that we're going to be heading in coming decades, which is climate change, right? So on the left, I have a picture, these are both this year, from a neighborhood in Northern California, where we're having massive problems with fires, and flooding is getting to be more and more of an issue. The house on the right is in Louisiana following a recent hurricane there. I think Louisiana got hit by 5 hurricanes just most recently this past week. In fact, it's raining here from from the remnants of that. This is not going away anytime soon. And so thinking about density, thinking about resiliency, sustainability is going to be necessarily a part of our experience with COVID. And hopefully we'll be able to figure out solutions that we can apply here as well. That is my distinct set of charts. I'd be very happy to chat and take any questions you may have. I can stop sharing so I can see people, but I can share back again if you like. I can't hear you at all.
Can you hear me now?
Yes, I can hear you now.
Thank you very much. This was such a beautiful presentation, very simple and very deep. Really impressed how lucky your students at Columbia and Johns Hopkins are. I know now. Now, I had a very quick question for you. We'll open up the forum for questions while others are preparing their questions. Professor, we know that the global economy has taken a very bad hit, and most of the countries are in a recession. Now, you are an economist also by training and not only working on housing, but you know the bigger picture also. Now, in some countries, housing sector is taken as a very important sector which facilitates the revival of the economy because of the interlinkages with other sectors. In a situation that you see today in the US, do you think the housing sector will be able to play that role? That is one. The other is the financial markets related to housing. You showed us the chart on the mortgage-backed securities, and you showed us the government is also playing a very prominent role in supporting the financial markets, including the housing scripts. Where do you see this in the next 1 year or 2 years? till the pandemic really goes away?
Okay. I'm not sure I caught all of that. Unfortunately, the volume here just isn't very high. But I think what you asked me is about over the next year and housing in its role as support for the economy, right? Um, and yes, we have seen that very much already in the Q3 GDP, which came out at 31% or something in annual rate. I think it's 7% in the quarterly rate. That seems a more digestible number, but the housing investment was far above that, 42 or 44%, something like that. And as I showed in my earlier slides, the amount of supply available for purchase is extremely limited, right? And that is what is driving it up. The trend of lower rates and a desire to move is very, very strong. Just very strong. And I can't imagine that we have the housing stock in place to satisfy the demand, and that will spur construction. And it's especially easier. It's hard to build very close to the cities, right? Because it's just it's already crowded. The regulatory situation is hard. But the further you move away from the center core, there's more space and more acceptance of this sort of thing. And so, we are seeing a distinct pickup on this side. And also, what limits that is commuting. It's just the further away you get, the more onerous commuting becomes. And so if you only have to go in 1 or 2 days a week or a week a month or something, then you don't mind a somewhat longer commute. So conditions are good for that and will persist. I think, given the size of this move, I think not just in 2021, but probably well into 2022 before we reach whatever the new equilibrium is. And that will stand to be a distinct support for the economy, no question.
We are open to questions. If anyone else has a question, please raise your hand. Uh, any questions for anyone, please let us know. Of course, I have a few more questions, but let's have the questions from the floor. Or any observations that anybody would like to make. Professor Kos, I had one quick question for you while others are still probably thinking of articulating their concerns. In any crisis, the housing prices do take a hit. Now, where do you see the housing prices in the US market now, given this crisis? And how long will you think the recovery of the housing index, price index would take? I saw the graphs that were showing on the housing price index and the GDP. Any projections on that, or where do you think?
So that's a great question. We are in this situation of persistent undersupply, but we also have to worry about affordability. And if you break house prices down by size categories, the lowest price levels are experiencing the biggest increases, the biggest demands, right? Because the supply shortage has been biggest there for particularly first-time home buyers who often don't have much resources in terms of money to put down and this sort of thing. So we've seen sort of a deceleration. Not only were prices rising if you went back to the one chart I showed, but they were accelerating, right? I mean, you'd had changes and the change was going up. At least the rate of change appears to be slowing, but there's certainly no sign yet that of anything looking like a turning point. And my own feeling is that it's just there will be a large pool of people ready to jump all over any decline in prices, particularly in, say, houses less than $250,000, $300,000, which used to be the median house price in the U.S. It's a fair amount higher now. Who would come in at these rates and scoop it up? So my best hope would be that it flattens out from here during this period as housing remains out of reach. If I go back to the global financial crisis, on this topic, that was so interesting was we had a very different theme. We had a big wave of foreclosures. And so many people lost their houses, prices plummeted, but the banking system was clogged. Lenders were reluctant to lend, for a variety of reasons. They were constrained. And so what happened, there was a huge surge of investor interest, both small investors and large organized investors who picked up these units, and many of them got established as rental properties. So rental properties single family became very big. In the last several years, as prices looked like they were peaking, a number of them were sold and we got some more balance back in the market. This is a lesson to policymakers that this would be a good time, if there is softening in prices, to have to make public funds available to buy up these houses and maintain them as affordable for first-time home buyers. That's something that would be very helpful on this side. But and also household finances are just very strong. Household finances, definitely improved from around the period of the global financial crisis. Debt burdens are considerably down. So I don't really see a chance of much distress there absent another big outside shock. If that helps.
There's a question by Professor Subramanian. Would you like to ask the question yourself, please?
Yes, Dr. Singh. Am I audible to you?
Yes, you are.
Thank you. Professor Kaas, here is a question. In India, we do have, even prior to Corona, COVID-19 period, and also after this Corona period where the entire economy has gone down, the housing stocks already built up. About 35% were unoccupied, roughly. And then also those who were hiring now after the Corona, people have migrated from the urban cities and all that, and have moved to the semi-urban and other areas back. And about 25 to 30% of stock are vacant. And further, the economy is very much affected, and the NPA with the banking system has quite sizably increased from the housing sector. What do you suggest? How this can be brought up? In how much of time it may take, in especially from Indian economy point of view?
Okay, so it wasn't easy for me to catch all this. Let me make sure I understand the question. So in the U.S., after the global financial crisis, we had this period of very slow recovery in housing construction. And that led to a pretty persistent, the beginnings of the supply-demand imbalance and rises in prices. And it really looks like one of the things COVID might do is finally get us the supply that I think we need, that conditions are right in terms of rate and where people want to live, that can happen. And you're asking the same thing about India. Is that what I understand in terms of what we can do to increase the supply of housing in places where prices are very high? Is that correct, or am I missing something?
Thank you.
I think,
Thank you.
Professor Subramanian, is that what the question you had in mind?
Something like that. But I wanted how much of time it may take. You expect the time span for the real genuine recovery to come back in India, in case we are able to push through things better with the stimulus and other packages.
So I have to say I am not so familiar with the current state of affairs in India. So the best answer I can probably give is to put it in terms of what factors would drive that decision. Now, as I understand it, there is some of this same behavior about location going on in India as there is in the U.S. Is that true that the smaller cities are experiencing some inflows, and perhaps in exurban areas that these are developing as well, and that's been going on for a while? Is that a fair statement? I realize this it's so huge, right? Even in the US, my stories, every city, every location is different. But that's the case, right? And it's there. So, in terms of, but the question is how available is the technology to allow people to effectively work together remotely, right? I think that has been the big revelation here, that even trading floors and the biggest banks, JP Morgan and Goldman Sachs, were really worried that they weren't going to be able to function well in this environment. And in fact, they function quite well. and so they are pretty committed to not having a need for everybody to come in the office every day, as far as this goes. So if that is widespread, and you can build an expectation of how you will live your life for some period of years, right? I mean, we're still not there yet. We're still not sure to what degree we'll be back, how often, by a year from now, right? Well, how much time will we spending in the office? That'll be an agreement between workers and firms, right? But if we are settled and say, okay, I am now happy to be here. Out in the suburbs, I have a bit more space. My kids can, have more space to run around and all this kind of thing. And I don't have to go in so much. Then I'm comfortable here, and we can build, and the builders can build, and it'll be fine. So, and again, in urban areas, there's always limitations, right? So, I mean, that's really what it depends on. But even here, you're talking a couple of years at least before we are in some kind of equilibrium. It just takes a while. Is that helpful at all?
Professor, there are a couple of questions. I'm going to request the people who are asking those questions. There is one question on mortgage insurance. I only see the number here. Do you want to ask that question directly to the professor, please?
Sure. I spend more time on mortgages than anything. Okay. So please.
Thank you, sir. My name is Shovan. I work with the only mortgage guarantee company in India called India Mortgage Guarantee Corporation. Sir, my question is, normally in a crisis situation, and we have seen this in global financial crisis as well, lenders are very, very skeptical of lending. So access to credit becomes a challenge, even if demand goes up. So that's one of the things. But
That's right.
in US and other developed markets, there are instruments like credit guarantee schemes like mortgage insurance, both offered by Freddie and Fannie, and private mortgage insurance companies. So my question is, how much impact such products have to spur housing demand or access to credit? Do you have any data or any thoughts around
Right,
it?
right, yeah, right. I understand what you were saying. Yes, yeah. Fannie and Freddie have proven them, and also Ginnie Mae and the government itself is about 30% of the mortgage market. Government agencies, Fannie and Freddie are GSEs, right? They're partly public, partly private, but they are still owned by the government. Since the global financial crisis. But they have been very important in giving lenders confidence in terms of lending. And they have served these roles actually quite well during this period. There are many issues for reform that need to be addressed with them, but their basic mission of keeping markets liquid has basically been fulfilled. I mean, I don't think you can you can really question that. Now, right now, we actually don't have enough capacity in the mortgage industry to satisfy the demand. So mortgage rates are very low; they're below 3%, but the spread of treasuries is still somewhat high. Treasuries are even lower than they were before the crisis relative to mortgages, and a lot of this is simply because the people lining up. Now you have to remember, in our market, you have the right to refinance. So the bulk of transactions now are refinances from people who have mortgages who want to refinance into a lower rate, and it's caused enormous demand. And what happens with that is the people with the highest credit get satisfied first because they're just easier mortgages to underwrite. So we are getting some credit tightness here. There's a question as to how much of it is the current situation and how much of it is just of excess demand. And it will be interesting to see how that goes. But we had a small private market. These tended to be for different kinds of mortgages, not the 30 or 15-year fixed mortgages that we normally have, but for shorter term adjustable balloon mortgages. That market was not too big, but it was pretty vibrant. It functioned, it was growing, and it's completely come to a halt now. I mean, there's next to no activity there because without the government backstop, the lenders just aren't willing to go on a lend. So, in this sense, I think their role has been met and satisfied. Reform of the system has been on the table since 2009 when the crisis is going on, and it's still very hard to guess how it will go, but it has been very important.
Thank you, sir.
Sir, we have questions, and I will just request the speakers to ask you those questions. The first question I'm going to request Mr. Hota to ask. After Mr. Hota, Naimat will ask, and after Naimat, we will request Ashok Vishandas to ask. He's the director of the EGROW, and then we will request Subrata Gupta to ask. Subrata Gupta is the former MD of a microfinance institution. He's asking the question from Calcutta. So can I request Mr. Hota to please go ahead?
Thank you, Dr. Singh. Professor Kos, as you are telling that now because of the pandemic, we are back to future, and in US market, the demand has exceeded supply. In India, the situation is otherwise because there are some oversupply, which is unsold inventories are still lying. but certainly the demand in the upcountry locations, tier 2, tier 3, that has been much higher. And if you go by the housing finance that is taking place, then we are seeing that in the month of August and September, we are better, we are either back into business or we are better than last year's August, September. So I suppose the good days for housing finance as well as the housing market is there. And rightly, as you told, maybe these are the best times for the housing sector because the rates have been quite benign, and that is the most important factor, that the propensity to buy a home during the pandemic has been much higher because they have to maintain the social distancing, work from home, and the preference of ownership over tenancy. This has somewhere increased the demand for home buying. It has pushed people to go for home buying. But the thing is, the rate of interest part, that how long the rate of interest has to be affordable, and the market has to be responsive, and this has to be sustainable, needs to be sustainable. What is your opinion, that how long really, how many years that these rates will be sustainable, that the housing can be kept affordable without much of government intervention? Right now, the government intervention and the liquidity push that has come from the central banks, the governments, and as well as the regulators and other agencies has been quite significant. So the present situation is somewhere induced one. What is your opinion about the sustainability world over, and your 1, 2, 3 points for all of us in the housing business in India?
Okay. So first, I'm sorry. I had a very, very hard time hearing you, and I'm far from sure I have picked up all your points. So I might have to try to summarize these. So you were talking about all of the policy measures that are supporting housing here. Is that?
Right now, the post-pandemic or during the pandemic period, whatever we are seeing, the increase in spurt in housing market, housing demand is mostly driven by this. These are
Okay,
policy
so
driven.
you're impacting housing demand, but you're not
But
necessarily impacting supply. Is that?
how long, as an economist and going by the world situation, the behavior across the countries, what is your perception about the sustainability of these rates and the demand going forward? How long it may be, it may remain?
Is there?
Yeah, we have
Hi.
a
Okay, here we
much
go. Okay,
increased home
so
buying now.
is it? I have not been using the chat function. Can we try that a little bit?
Yeah,
I'm sorry, but
Dr. Singh, if
it's
you can
just
actually.
I'm just not picking this up very well.
Professor, what Mr. Hota is saying is that for the housing market, there have been incentives both by the government, the central bank, and in a way, this is a good time for the housing market. What you exactly said, that, there are houses which are available and which can be now, the government can sustain them and maintain them, probably buy them into the affordable housing market. How long will this phase last? Mr. Hota, is that in essence what you were trying to ask?
Yeah, key to it is the rate of interest.
Okay, so
What is going to be
it's the government actually owning, getting hold of the properties.
No, the point that
And
Mr. Hota is making is, Mr. Hota is saying the interest rates are low. There is incentives on the housing sector, and this is a very good time for the housing.
exactly?
Yeah, and this is the time to really pitch in and benefit from it. In a way,
Exactly.
the government and the central bank has incentivized this sector, and the market should make the most of it. That's the point he's making, and he's asking you what is your opinion on his observation.
okay, I think I'm getting there. So the housing market is good. It's functioning reasonably well. the central bank is keeping rates low, markets are functioning, and so we're there. So we're seeing these programs where the government picks up the houses and maintains them and all. It's something that can be suitable maybe for affordable housing or something, but on a broad scale, if the market's functioning well, that's not something that needs to be an emphasis. Is that the point?
Sure.
Okay, so yes, I agree. I agree with that completely. And actually, the opportunity for the buying that was there in the global financial crisis because prices had fallen so spectacularly. Became clearly undervalued, and it was only the resources of only investors had the resources to take advantage of that. But that kind of distortion is not here now anywhere near to the same extent. That's right. And that's it. So if we want to go on about affordable housing, it may well be other things that we talk about instead of this, the dynamics of the center of the market. That I would certainly concur with.
Professor, there are a couple of questions. Some of them have come on my cell phone. What I'm going to do is I'm going to request Dr. Ashok Vishandas, who's my colleague on the EGROW Foundation, to ask his question. And then we will go to Naimat. Then we will go to Mr. Subrata Gupta. Then we will go to Vijay Kumar. And then we will conclude with Vinay Gupta. So you have a choice. You have a choice. They can ask the questions, and then you can decide how much time you want to spend on each one of them, or if you think there are common answers, you can mention it. So I'm going to request the participants, please ask your question, starting with Mr. Ashok Vishandas.
Yeah, I have a what we call here a hard stop at 9:30, so I have about 20 minutes that I can stay here.
This is perfect. That's why we'll ask.
Okay. Yeah, that sounds like it should work, but just.
And you can prioritize it. Yeah, please go ahead, Dr. Vishandas.
Yeah, you're muted. Your mute is on.
Mr. Vishandas, you have to unmute yourself.
Okay, am I audible?
Yes, you are.
Yes, and I hear you very well, unlike the others. I don't know what it is.
Well, I must congratulate you for masterful exposition. The question I have in mind, the other participant has asked, but I asked very simple question. In addition, see, in India particularly, when it comes to the housing, in the post-COVID-19 period, the government has given a moratorium to the housing buyers to repay their annual EMI. So that is one aspect. So how banks will deal with this? Because and more particularly, the people who give the deposit to the banks, how safe that deposit is, because bank do not generate the money on its own. When by government order, banks are asked to give moratorium and so many concessions to the loanee, be it housing or any other purpose, how bank will do this, and to what extent, according to your opinion, the depositors' money is safe?
Right. So,
Professor,
I mean,
Professor,
so bank deposits are government insured in the U.S. up to, I forget what the cap is, at least $100,000. So there's a government agency, the Federal Deposit Insurance Corporation, that insures these deposits. So if a bank gets into trouble, depositors are protected, and I have that's been true since after the Great Depression, and I don't think anybody has ever challenged that would not be the case. In terms of the bank's overall financial health, yes. So we have this forbearance process, and that does put strains on the financial conditions of the banks. But right now, the huge transaction volumes that they are generating seem to be generating income greater than the costs of having to cover the costs of forbearance. And it's actually very interesting. So the non-banks in the US, a majority of them are private institutions. They are standalone, or they are owned by other financial institutions. But in recent months, 7 of them, which is a large number of the biggest ones, have put in to do an IPO, a listing to go public. And the reason is because the market is so strong, and the view is that it will remain strong for a long time, that this is a good time to raise equity to build out expansion and technology planning. So we will see if the market is too optimistic about this, but at the moment, sentiment is pretty strong.
Naiman, your question is pretty similar. You want to ask him?
So firstly, sir, thank you so much for this talk. It's been really informative. So I basically wanted to ask about NPAs, whether NPAs will increase from the housing sector in the US, and are the banks ready for such a increase, sir?
So non-performing assets, is that?
Yeah, yes, sir.
Yes.
Right. Yeah. So this is going to be the big issue next year. I mean, as I showed now, we still have about 3 million mortgages that are in a state of forbearance. And if this will start to run out in the spring, and then there is a question about what will happen at that time, of which an increase in NPAs is certainly one possibility. A lot depends on the state of economy at that moment. If job growth starts to come back, it won't look too bad. Another piece has to do with what happens to the value of the collateral, what happens to the value of the house. Right now, recall, we are in a rising home price shortage of collateral, right? So, taking in a modest amount of new houses for sale could actually be okay from the standpoint that there just aren't enough of it now. But this is going to be important in 2021. There are a wide range of views about how this will go. But if I had to look at a market consensus from when I talk to financial operations, is that the feeling is that it will, unless there is another, what we call a double dip, another downturn in the overall economy, if we just continue on a modest path of growth, that absorbing this shock shouldn't be too difficult. We will see. But it's a great question. That's what we're all thinking about.
Yeah, I'm going to request Subrita Gupta.
Good evening, sir. Can you hear me, sir? Hear me, sir?
Yes, I hear you fine. Can you hear me?
Okay. My question is that in one of the slides you explained that the rural demand is increasing more compared to the urban demand.
That's right.
Is it because of the fact that many of the people are opting for a second home where comparatively it is a secluded place, or is it because of the fact that for some other reason that this is happening? Is it for the second home, or is it for any other reason?
That's another great question. That is certainly part of the calculation, is second homes. particularly say around here, New York City, the very expensive places, San Francisco, for example, there is a distinct move in this direction. So, and I think it's even for people, if you can afford it, if your financial situation will allow it, the second home is a hedge, right? You can decide what to do, right? So you can go and move permanently here, or you can treat it as a weekend vacation kind of property and come back in. So that is part of it, and I don't think we have a good sense on the magnitudes here completely, but we are experiencing this great outflow. I think inevitably there will be some retraction, but the degree of that is very much up in the air. But that's a very good point about the second home.
Mr. Vinay Gupta, would you like to ask the question yourself?
Yeah, hi, my name is Vinay Gupta. Actually, my question has already been answered. The only thing which I wanted to figure out, one of your charts mentioned that as of now, roughly 3 million houses are under forbearance program. Now, what is this 3 million as a proportion of total loans outstanding? If it is 60%, 70%, or is it a low percentage?
No, it's quite small. I think there are 80 some million mortgages in the US, something like that, right? So the 3 million is small as a percentage, right? It's not a small aggregate number somehow, but it's relatively small. I mean, I mean, the mortgages you worry about are the ones that are generally less than 5 years old, where these days, prior to the crisis, we haven't required much money down. A lot of people put 5% or less of the money down, and this tends to make you pretty vulnerable. But over time, you start to pay off your mortgage, and it goes down. So if a lot of these mortgages, because there's 30 years, right? They're in the second half of their life, but it's it's more than 50% equity, and you're not worried about them because the asset has value kind of no matter what. So that 3 million is there. I think 10 million people lost their houses in the global financial crisis, something like that. Was a quite much larger number. But again, the big difference being house prices had plummeted, and here they had not. You have every incentive to stay in your house if you can afford it.
Yeah, so that's yeah.
I mean, it's just a huge difference, right? In 2009, your mortgages were 30% more than your house. How much are you going to struggle to stay in it? I mean, it just but now there's definitely an incentive.
That's a good news. That means the chances of this getting converted into a housing finance crisis is very, very low.
Yeah, I mean, it may well be. I mean, if you're in a job sector and it just isn't feasible anymore, you're in some part of the service sector, your job isn't going to come back anytime soon, you have to adjust your life, right? But if your asset has value, then you're still pretty flexible, right? I mean, we were not flexible after the global financial crisis for many years. Too many people were locked in their homes. But now there's a lot of flexibility and we're using it, right? There's a lot of movement.
Thank you.
I would just thank you, Professor, but there's a question from one Mr. Praveen Kumar. Mr. Praveen, can you, and that'll be the last question, please. I know the professor.
Okay, great.
I had requested the professor only 60 minutes, and we have been very greedy and taken almost 90 minutes. So, Praveen, can you ask your question? Mr. Praveen? Can you please ask your question? You need to unmute yourself. Professor Kos, I'll read the question for you. He's put it on the screen here. The question is that with COVID, migration patterns are expected to change. In India, of course, lots happened between the urban and the rural areas, and lots of rental houses have fallen vacant. Will that have an impact on the supply and demand of housing in USA? So within the housing market, there may be patterns. That is one question. And the second question is, people are working from home. Has it impacted prices of housing in the USA, which should have? What is the status of unoccupied rental homes? And I think
Yeah,
related to
yeah.
it,
Yeah, that's a great question. And I haven't touched on the rental market at all. But that actually is going to be very, very important next year as well. So the economic shock here is very much fallen on lower income service sector workers who tend to be mostly renters, right? You know, these are not your homeowners. And so, you know, technology, office workers, this sort of thing, it certainly has had an impact depending on what sector you're in, but it's nowhere near as much. And so actually, in the end, the status of the rental market is there. So right now we are in a situation of there is a ban on kicking people out of their rental units. And so if you cannot, and the rental market is nowhere near as organized as the ownership market. There are a lot of the rules and regulations about this tend to be set at a local level. So what the policies are about you know, rental homes. So there aren't very many unoccupied rental homes, but there are a lot of rental homes where people aren't paying their rent because they don't have jobs. And for right now, landlords are prohibited from moving these people out. But right now that goes, and that's a federal rule, that goes only till the end of this year. So the end of December. So eviction, right? You can't evict somebody, and that's a public health measure. It's not an economic measure, right? And what happens after that is also going to be very, very important. We also worry about the financial state of landlords. Landlords are you know, have debt nowhere near to the extent as the single family market. There are some programs for forbearance for landlords, but they are much less extensive. Most of the time, if you're a property owner and you rent, you have to work something out with your bank if you have something going on. So this is a very difficult process. And I think you're going to actually see more of this with the retail sector, because a lot of these stores are being shuttered. These large chains are never going to be occupied for a long time, and for office space, because so much less office space will be used. So this is an issue that's going to come up next year. That's extremely important across the entire commercial sector. And that's something we're going to have to watch. It's a very good question. Thank you.
So let me conclude now by once again thanking Professor Richard Kos from Columbia University, who has spent nearly 90 minutes with us. As you have seen, the discussion, Professor, has been very intense, and I know there are questions which are coming up, but people are aware that we had invited you for basically 60-minute talk, and it has gone to 90 minutes. Normally, we generally wrap up in time, but seeing the interest that was coming from the participants, we allowed it to roll on. I must inform everybody that today's discussion was very rich. We are going to place it on our website tomorrow morning in about 12 hours. You're welcome to use it. It's very, very, I think, educative and informative. And the way the professor has analyzed as well as the richness of the discussion and professors' responses were very enlightening. I also would like to make an announcement for the next Friday. You know, this we do every Friday knowledge-based webinars for the general public. Next week, we have a fascinating topic that we are covering. It is on banking issues, and we have two former EDs who will be there, who are hands-on. One is Mr. Bena. He is with Mr. Jani. He is with us today, and one is Mr. Talia. And then we have from the rating agency, Mr. Madan Sabnavis, who the chief economist at the rating agency, who will be also speaking to us. So next week, November 6th, Friday, 5:30 p.m. again, we will be requesting you to please join us. And for today, once again, thanking everybody, Professor Bose, as well as the participants, to have made this discussion so vibrant and so dynamic and so informative. Thank you very much.
Thank you so much.
Yeah, no,
Thank you.
thank you for the opportunity, and I hope very much to stay in touch. I'd be interested in hearing more about the mortgage market in India at some point. So perhaps, Sharon, we will be in touch in coming months. That would be great.
Thank
And
you.
I'll send you my slides.
Thank
Please,
you.
thank you.